I'll say good afternoon. I'm Scott Forcino, an associate broker of Real Brokerage in both New York and Florida. I founded PlugIntro so that real estate professionals and their contacts and colleagues can promote their business locally and offer their friends and other connections a chance to promote their business. We have a host of one of the important groups here, Clarissa Hootie.
Chueire.
280, close. It's a very hard name. And she's a friend for a long time. I know she's a very experienced mortgage professional. She's with Green River Capital, both in New York and in Florida. And there's a lot to talk about. Today is the 29th of September, and rates have hit really almost record highs. Clarissa is going to tell us all about it. Also how they work within law enforcement with regarding financing, and how Clarissa structures deals with their referral partners and realtors to close them. So good afternoon, Clarissa.
Hi, Scott. How are you?
Great. So you're working in both markets, correct? New York and Florida?
Correct. And you touched on a very hot topic, the rates. They definitely have gone up more, and that's triggering us to have to be creative once again with structuring deals. And funny that you touched on that, because the last two transactions that I had, we actually had to get a little creative because of the rate increase, and sellers concessions and temporary 2-1 buy downs are pretty much back again.
Okay, so we got to, hit into those three things. Rates that were in 2020, 2021, and the twos and even the mid threes, now what does that do? It may sound like too simple or basic of a question, to rates in the sevens and eights. I mean, what happens to that buyer? They just can't afford the same payment?
Oh, it's a huge difference. I mean, the affordability goes down. Sometimes they can qualify, but they're just not comfortable with the payment. And the most useful tool that we have at the moment is the 2-1 temporary buy down. There's other alternatives to that where you can do it for 3 years, but we think rates may come down in the next 1 or 2 years. So I just had a transaction where the client was not comfortable with the payment. There were some issues with the house, and I recommend that instead of getting a price reduction, I spoke to the agent and I said, let's do a temporary 2-1 buy down. So if the rate at the time, the rate was about 7.5 with a buy down, with the client paying 1 point, we negotiated to have the seller pay. The cost was about 2 points. It was done in the form of a seller's concession. So the interest rate was actually 5.5 for the first 12 months. It went up to 6.5 on the second year, and then 7.5 was the final interest rate. And the hope is that the client will refinance by the time it gets to 7.5, within the first 2 years. The interesting thing is when the seller pays for the temporary buy down instead of the lender, because that's also an option. If the client refinances before 2 years, I don't know if you know this, they actually can use the concession portion that was not utilized towards a future refinance if we refinance the same lender. So they'll do a principal reduction.
Okay, so there's a lot there too, and I hate this phrase, unpack. I hate when people say it, but I'll say that we've got a lot of things, because not everyone knows what 3-2-1 means, and not everyone knows what a seller's concession means. We'll go into that and how it can help people. And also, we talked about the temporary nature of a buy down. Now, the usual world that we're all used to is buyers apply for a loan. They may or may not pay discount points to reduce the rate. People always wanted to hear the rates of no points, and they did not get the best possible rate. So in this case, you're talking about something that is unusual, where the seller making some either concession, which I think, tell me if it depends on the appraised value, or a contribution. And then lastly, I don't like the 3-2-1 because I think that could lead to some sticker shock. I think that instead of a price reduction, people should just push that money across the table and give the buyers a permanent reduced rate. What do you think?
Well, the thing with that is when you do a regular buy down, you don't get the rate as low as when you do a temporary buy down. It's just built differently. So if a buyer were to pay 2 points to reduce the rate, they're not going to get 2% off the rate for the life of the term. So you just get a bigger rate reduction with a temporary buy down.
That makes sense. But, my thought is that there has been such an increase in value and equity that sellers, when they're not selling, that unfortunately the listing agents say do a price chop, to a price improvement, which is, I think, a silly term too. Um, in that case, it's almost fake monopoly money because no one went to work and saved it. It just went up in value while they slept there. So people, I think, now are more so throwing the 5% at the deal. Now, what's the maximum that a seller can offer to offset buyers or reduce buyers' interest rate? What's the max?
So it varies because it does have to pass compliance. So if you run into high cost, it can become a problem. I mean, I've played around with 2 points. I haven't had a problem. But it does vary on the state, because it can only be a percentage of the total closing cost. So we have to watch out. You can't just sell that. Like you can just buy down the rate 5%. That may not be realistic.
So 5% off the price does not, of course, mean five. What would a 5% in an ideal, chop 5% off? Let's say a $500,000 house, you reduced it and gave 25,000. What could the buyer experience? How much a lower rate?
So every 1 point, so to reduce the rate by 2% on the temporary buy down, it costs approximately 2 points. So that will get you from 7.5 to 5.5, but it's temporary for the first year. And then the second point would get you the 6.5 on the second year.
Mm-hmm. So how do you figure that? If they have a certain debt to income, that means you must qualify them at the worst, highest rate.
Yeah.
And
They still have to qualify a worst case scenario. It's just to give them some breathing room and have a lower payment while you're waiting for the rates to come down. But they absolutely have to qualify at the worst case scenario because if they never refinance, they still need to meet guidelines. Another thing.
Let's say we do this like you did. The rate was 7.5 and they experience this buy down. What happens if the prevailing rate is 9? They don't have the 9. They have just what was the prevailing rate as of today?
I'm sorry, I didn't follow that question.
Okay. If the deal you're describing, it sounded like the rate was 7.5, right? It's
right.
about.
Right.
So then they did the 3-2-1. It was 6.5, 5.5, 6.5. That makes sense. So in the third year, will they have the benefit of 7.5 even if the rates are 9?
Yeah, so it's a 30-year fixed if that's the product that they're doing. So it would go 5.5, 6.5, 7.5 on a 2-1 buy down, but then it stays at 6.5 for the rest of the term.
You mean 7.5?
7.5, yes. It stays
right.
At 7 the rest of the term.
And that still might be a savings if rates go to 9. So at least you're in a way locking in the savings because we don't know where this is going.
Right. And if they come down, they can refinance and they don't lose that money. That's what I was mentioning before. We can arrange to refinance with the same lender where let's say rates come down 12 months from now and they pay 2 point, let's say the seller or the builder, whatever the circumstances were, paid 2 points for that buyer. They don't lose that money if they don't stay in the loan for 2 years. We take the balance that was not used and we can apply that towards the principal on the refinance.
Right. Okay. That reduces their amount they owe. That makes sense.
Right. And then another technique is you could do a 5-1 arm or a 7-1 arm. It's a little riskier. So we do have some portfolio lenders that are still lower on the adjustable loans. So we could combine the temporary buy down with that as well. So let's say if they're at 7% or 6.99 instead of 7.5, you can do a temporary buy down around that and be a little bit lower.
That makes sense. Now, you're a mortgage pro, a real experienced professional. How does the regular realtor explain this to a listing agent on behalf of the buyers? And I also wonder if it's a good idea for you professionals to speak to the listing agent so they could offer this to the buyer's agent and have no friction of making the request. It could be like, here's a gift from the seller versus the buyer asking for some treatment that the seller never heard of.
No, absolutely. I actually had that happen recently. People are really inquiring a lot about the temporary buy down. So I have a realtor who has a listing from a builder, and the builder he asked for some advice. How could he market the property to make it more appealing? So I recommended the temporary buy down, and we were discussing how to promote that as part of the listing. So I did have to, get involved, obviously explain to the listing agent, but I think that's a great tool. They just did an open house, and the builder will be offering to buy down the rate for whatever buyer, is interested.
That's a good idea. So one thing I learned here is that the permanent buy down closing cost contribution gets you less of a reduction in the rate than the 3-2-1. I did not know that.
That's what I was for. Yes, people think they can just buy down on their own. It's not the same impact on the rate. So it does, the best deal that you get. Also, when the seller pays is the best deal, there is an option where the lender can also give you a concession to buy down the rate, but the final rate is a little bit higher than market rate.
That makes sense. But why do you think it is? I'm just curious. Why do you think it is that the money pushed across the table by the seller is not as good as 3-2-1? Why do you think that is? I don't.
The lender has to make a certain yield spread, right, on the loan. If they're paying for that, they're limited on how much they can pay. There still has to be a profit for the lender, so they don't have unlimited funds
No,
versus.
I mean to say from the seller side. If the seller is going to pay them where the buyer doesn't for the discount points, the seller's contribution from their closing costs just off the top seems like it's less than
That's
if.
correct.
Why do you think that is? I'm trying to think.
Don't know why. That's just how they set up the temporary buy down. It's really more geared towards, being a seller's contribution. Probably because the cost is, it adds up. If a borrower is paying their regular closing costs and then they're gonna pay another 2 points, that gets to be a lot, versus the seller is making a contribution from the net proceeds. It's more manageable in this market.
Well, I'm trying to think. Maybe they'll give you this kind of a teaser rate, like the old days it was a teaser rate. Maybe the 3-2-1 is being regarded by the bank as a teaser, and they're happy that the 27 or 28 years will be at the higher number. Maybe that's why. I don't know. Interesting. So, what are your efforts to explain this to agents that this is a good approach? I mean, do you have seminars? Do you reach them personally?
I'm talking to them personally on each transaction, and anytime the client is debating, making an offer or not because of rates, that's when we're having that discussion. I just had a transaction in Florida where the client, so in Florida, you sign the contract first, unlike New York, and then you do the inspection. So in the middle of the loan process, there were some issues with the house. And I proposed, instead of asking for a price reduction, I spoke to the agent and the client who had already inquired about the temporary buy down. That would be a good opportunity if you want to still purchase the house to renegotiate with the seller, but ask for a temporary buy down since you're not comfortable anyway with the payment instead of a price reduction. So at least we can give you a little breathing room the first couple of years of the loan. So it's been coming up a lot. I have to say, almost the last few deals that I worked on, either there was a conversation about a temporary buy down, the listing and open house property I mentioned to you, and also I did a VA loan in Florida, and we had to structure with a seller's concession. But VA has a lot of flexibility. It sounds like it doesn't. When you check the guidelines, you can only do a seller's concession up to 4% with VA financing. However, you can work around that because in addition to the 4%, the seller is allowed to pay for any loan related fees. So what we do is we allocate the 4% to the prepaid items, and then they can still do seller paid for all the other fees pretty much. They can pay for buy down of the interest rate. So you could end up having a 7-8% seller's concession by working around it. So I ended up doing that. I had a seller that basically paid for all the closing costs.
I think that's great because that's really the key obstacle now is the monthly payment. And if you could at least make it easier for the buyer, then properties are sitting on MLS longer. It's a lot of bad news. They have to do whatever they can to make it appealing to the buyers.
Yes, in this case, we needed to do that to make the deal close. There was no way around it. So it made sense for the seller. At the end of the day, it made sense for the buyer. But yeah, you can, if you really use all the tools and programs out there, there's a lot of flexibility to structure loans and get creative.
Interesting. So I know you're a big member of the Florida reload team from New York to Florida. It seems like a corridor, especially in wintertime, and people see properties, and there's been this rise up in interest based on tax consequences and climate. I mean, it's nicer in Florida, right? Ride your bike in January,
Yep.
jump in the pool. So tell me, what is the Florida relocation team? How do you work?
So the Florida relocation team includes myself. I'm a mortgage broker. We have a real estate agent who's from New York originally, who has been living in Florida and is licensed to do real estate in Florida, and a title agent who also used to live in New York and relocated to Florida, and she handles the title services. So it's basically a one-stop shop concierge service where we provide real estate, mortgage, and title services, and all three of us originally lived in New York, so we have an understanding of the New York market and how things operate there in the real estate industry. We all relocated to Florida at different times, but regrouped to basically assist anybody who is trying to relocate from New York, not limited to New York, but that's primarily our market, from New York to Florida, or if they just want to make an investment, we educate the buyer on the Florida market and how is it different than New York, so they don't have any problems, right? Because in New York we know we have lawyers that handle contracts. In Florida it's handled by the realtor. There's a lot of differences, so we educate them throughout the process.
Sure. There's even closing dates. Would you speak to that issue? I know they're real in Florida, right? Unlike New York.
Absolutely. So in New York, your typical contract of sale will have a closing date on or about, let's say, December 15th. That basically gives the buyer or the seller flexibility, if needed, to stretch that closing date out another 30 days. Versus in Florida, the closing date is the closing date. If you can't close by that specific date on the contract, you have to get an extension from the seller, which may or may not be granted. It depends on the kind of market that we're in. So the closing is pretty firm, versus in New York, there's a lot more flexibility.
I wonder why. I mean, you'd think New York with lawyers would have less, and yet they have more flexibility.
Well, also in New York, the title takes a lot longer depending on the municipality. They're waiting on municipal searches. And, if you order title in the Bronx, you can get that fairly quickly in a matter of a week. If it's Putnam County, it could take several weeks. So I think there has to be more flexibility because of that. In Florida, title is usually pretty much in within a couple weeks, 1 or 2 weeks.
That's interesting. And I know there's settlement companies or real estate refers settlement companies to actually close the deal, and there are no lawyers.
Right. Right. I mean, some title companies have lawyers, but not all of them. The majority doesn't.
Interesting. And I know one thing you handle quite a bit of is the law enforcement, and you work with those professionals and first responders. How does that work?
Yes. So, I mean, I was involved in that in New York for many years. I had a PBA program that I was part of in New York, and the Florida relocation team has extended. We created a separate division just for law enforcement because there's so many incentives out there as it is. The governor of Florida has given a cash bonus incentive of $5,000 to police officers who want to relocate to Florida. So we kind of built around that. So the Florida relocation team has put together a program where we will give additional discounts to police officers when it comes to lender fees, if they're applying for mortgages, title fees, and even like moving expenses. So we have, extended our resources. And in addition to that, they can combine that with many other great programs. The Hometown Hero, I don't know if you ever touched on that. Originally, that program, which is specific to Florida, was only available for police officers and union members. Now it's actually open to any resident of Florida, where they can get up to $35,000 towards down payment and closing cost assistance. So when you combine that with the cash bonus incentive of $5,000 to relocate, what the Florida relocation team is giving in additional benefits, there's a lot of help out there. Not
Hmm.
and through VA financing, they can do 100% financing if they need to, and even FHA, depending on income limits.
Yeah, I mean, those professionals need this kind of incentive because the great work they do for all of us.
Absolutely. I mean, they did run out of funds recently. That has happened before. This time, I don't think they're going to replenish until 2024. But we do have alternative products, like I said, FHA, VA. We can still do 100% financing and provide all the other incentives.
Hmm. So I know there's other options. Does your company handle non-QM or any other type of exotic program such as that? What would you describe?
And I have to tell you, in Florida, it's very different, the type of loans that I do in Florida versus New York. New York, it's been more FHA, conventional VA. In Florida, I would say the majority is non-QM. I'm doing a lot of the SCR loans. That's a cash flow program designed primarily for investors. So instead of providing their income documents, we're qualifying based on the rental income for the subject property. As long as it covers the mortgage payment, that's how the lender qualifies the loan. So that's a very big one in Florida. The bank statement program designed for self-employed borrowers who have the cash deposits going to the bank account, but they're not necessarily showing their income on their tax returns. So that's very popular. A lot of foreign nationals, a lot of foreign national deals, a lot of fix and flip, Airbnb financing.
Hmm. Are those credit driven as well, like a conventional, or like the deposit loans?
They all have minimum credit score requirements, but you'll be surprised. I mean, they're pretty flexible. I recently did a loan. It was at the SCR with a 660 credit score. Of course, the rate is priced accordingly, but you don't see those products for 500 credit scores. That's really more FHA, but even a little bit below average, you can still get financing.
Hmm. What if the properties are owned in an entity? I think they would be if they're at all investments.
A lot of these lenders allow to close in an LLC. That's not a problem. That's part of the program.
What kind of credit is derived from LLC? How do they arrive at that figure as far as risk?
So in the residential world, the loan is really done in the borrower's name, but when
Hmm.
it the title, they can set up an LLC right before they do the loan or even after loan approval. And we just just put the title in an LLC, but they're actually applying for the loan. It's really no different than commercial. In the commercial world, the LLC is applying for the loan, but they have to personally guarantee it anyway.
I see. Okay. That's so it's based on the members, and they can put it into another entity. It's interesting.
But with residential, that mortgage is definitely going to get reported on credit. I don't always see that with commercial. Sometimes it does, sometimes it doesn't. It should, because they personally guaranteed it, but sometimes it doesn't show up. In the residential world, you always see the credit because they applied in their personal name. It's just the title is in an LLC.
Okay. And what have you seen? Have you seen, based on these rates, a downtick? Are there fewer loan applications?
Um, I have to say, so those rates are typically about. I just priced one today this morning. It was around 9.899%. So mortgage rates went up in January, as you know. So usually they're about 1 to 2% above what the current rates are. There's still a lot of investors taking advantage because I think if you're doing an investment property, it's different. They're looking at cash flow. At the end of the day, an investor doesn't really care what the rate is. If they're making money off the property, they're locking in that property now in this market because they know when rates come down, prices are going to go up. So they're locking in the deal now. They're taking the higher rate. As long as the property cash flows, the goal is just to refinance, and then from that point on, it's just going to be a bigger profit.
Okay,
It's
but
that differently.
even if we have a higher rate than, let's say, 2 years ago, rents go up. So that
Correct.
could, so even the rents go up a bit, even incrementally, depending on the number of units, that would take care of the interest increase easily, I would think.
Absolutely, yes. So we're still seeing a lot of the DSCR. The slowdown is more actually with primary residences, in my opinion, not so much the investment world.
Right. Well, someone who bought in, or they refinanced, I should say, in 2021 with about a 3.5, how are they looking at the rate of 7? I mean, how are they doubling their payment to the new house?
Say that again. I'm sorry.
How is someone affording, let's say they borrow the same amount of money for their next purchase? I mean, they're going to get a real sticker shock.
I mean, you're depending, I mean, on a $500,000 loan amount, it might be a difference of an extra $1,500 a month. It's huge.
Wow. That is huge. Now, the only I've heard arbitrage against that is if someone has a lot of equity, and that means they have that much money to pay that income.
I'm sorry, Scott, I got a phone call.
Okay. I've heard of homeowners, and even myself, if you've gained a lot of equity in the property, that's tax-free income, depending on how long you've lived there as your primary residence, whether you're married or not. So wouldn't that really counter that 1,500, at least a lot of it, if you're using the bank's money? I mean, that's not your money. It rose in value without your effort. So people are saying, you know what? Yeah, I never would have expected this much equity, and I never would have expected that payment, but I'm using that equity to pay my payment.
Mm-hmm. Yeah, it all depends on how you look at it. Absolutely. And they can still take out home equity loans. I mean, I don't do a lot of home equity loans, and those rates are pretty high, but people are holding on to the low rates because they know they're not going to come around the 299s anymore. And supplementing with home equity loans. Now they're coming out with home equity loans for bank statement as well. For borrowers that cannot qualify based on their income, they can, go off the bank statement. So there's, a lot of products went away recently with the rate increase, but there's still so many options out there available.
I would think, is the HELOC based on the equity in the property, the loan to value?
Yes. So because it's a second mortgage, it's going to be a little more restricted. But some banks are pretty flexible, in my opinion. I've seen banks go as high as 89.99% financing if it's a primary residence, assuming we have a good credit score. And then it goes down how much they lend depending on credit score, property type, and so on.
It's interesting stuff. I mean, we're definitely in a fluctuating market. What happens? Realtors with whom you've created relations have referred you. That's the normal course of events, and you provide that education. I mean, is that before they start looking, or I guess when they need a loan to make an offer?
We usually speak at the pre-approval level. I have a very detailed conversation with the client to see what their budget is. How does the payment compare to their expectations? What kind of resources and tools should we be utilizing when they're looking for a property? And a lot of times it does require me having to speak to the agent up front because, as you can't work out a seller's concession or a temporary buy down after the offer was made. This all has to be discussed up front. It's very hard to make an offer and lock in a deal and then go back to the seller and start asking for concessions. So it all should be presented up front. So it's something I educate them from, the beginning of the process. And when we do have problems and challenges come up, that's when we regroup and try to figure out what can we do here and brainstorm to get the deal to close.
Right. I think in this market and these rates, I think it really has to go from seller backwards. You have to read from right to left, where the seller has to make the house more attractive and gain more bees with their better loan honey. If my house is 500,000 and your house is 500,000, a seller can elect to demonstrate the payment based on the loan to value and can say this house comes with the lowest possible rate because I'm ready, or I'll structure it that each of us pay towards the closing cost, 3-1 or whatever. This is from the listing agent. I don't know that listing agents are aware, or on a large scale, that they have the ability to control the exposure the house gets just based on payment.
No, I think you're right. I think it should definitely be worked out backwards, and it's really a matter of educating them and making sure the realtors are aware of all the resources available. Absolutely.
Interesting. And if you're not doing that, you're just competing against the ordinary others. I think in this market, you have to have something that really stands out. And also, I mean, you talk about backwards. It's always gone realtor to lender. I think now we're entering an era where it's going to be lender starts the process because without them, there is no deal.
Right. Interesting. Yeah.
I mean, I think they should, and I thought that for a while, but now it's really important where the referrals should not necessarily go from realtors to lenders. It should be that, we're the gatekeeper. If you don't, I
Right.
don't care what you offer. If there's no money at the closing, you're not getting it.
Right.
I'm a big proponent of the lender demonstrating that they are the way to access a transaction.
No, I like that idea. No, I agree with you. Absolutely.
I mean, are banks doing that? I mean, that seems to be the next place.
It makes sense what you're saying to me. There's just so much out there, that's just getting lost. Not everybody's aware of it.
Right. Have you become, or the banks are talking about this Department of Justice lawsuit, which could end as buyer agent compensation as we know about it?
I don't know much about that.
Okay. Well, there's a lot. I mean, the way the buyer's agent is compensated from the listing agent who gets their arrangement from the selling agent, that could change and
Hmm.
coming up quickly. So, I mean, I'm always wondering about the agent's relationship with their service providers. It could very well be that the buyer's agents are no longer compensated, and it seems the banks and other services have to go directly to listing agents. So, what we're describing, this collaborative strategy, I think has really, really come to the forefront pretty soon.
Yeah, they'll definitely change the dynamic of things. Absolutely. If that were to happen.
Yeah, and that's what's a lot of concern. Well, I understand the Fed is saying that we're talking about these rates through 2024.
I believe 1 to 2 years is what we're looking at.
Wow.
Yeah, usually quoting rates, proposing if the client is doing a buy down of at least 1 point, because I don't see the rates coming down that quickly. Um, if they're okay with the rate, paying 1 point, I think it's reasonable. Usually you make your money back in about a year or so, a year and a half. If you see that kind of break even point, I think it makes sense because it may last another 1 or 2 years, is what they're saying. If they overpaying points, the concern becomes if they refinance too early, now they're throwing money out the window because you don't give yourself a chance to recuperate that money. But
Mm.
that's why I like the strategy with the temporary 2-1 buy down. You don't lose the money that was used to buy down the rate. It gets applied to your principal. It comes back to the buyer.
And how much would that be? We're not talking a lot of money. We're talking a few percent.
Well, so in the example I gave before, let's say the seller was paying 2% of the loan amount. When I say 2 points, I'm talking about the loan amount. So let's say the loan amount is 500,000. If the seller's paying about 2%, that would be 10,000 towards buying down the rate. Let's say that the borrower is in the loan only for 1 year. So 5,000 out of the 10,000 would get credited towards the borrower's principal when they refinance, versus when they buy down the rate and they're paying themselves. If they overpaying points and they refinance too early, that money goes out the window.
And when we talk about refinances, we're talking about two different breeds. The Florida refinance is straight, and the New York oftentimes uses a consolidation, which
Yeah.
means lawyers and documents and more of a delay and even some mortgage tax. You want to touch on that at all? The different species of these type of refinances?
Yes. So in Florida, there is no mortgage tax that the buyer pays. The closing costs are a lot lower. So when you refinance, it's very straightforward, as you pointed out. Versus in New York, when the buyer pays a mortgage tax, which is a percentage of the loan amount, and it can vary anywhere between 0.8, almost 1%, let's say, to 2.25%. So on a big loan size, that's a big difference. If we're talking 500,000, they could be paying $12,000 in mortgage tax.
Right.
So
And that's in New York City, of course.
that's in New York City. Yeah, the five boroughs like the Bronx, Brooklyn, Queens. As you go more north, it starts going down. But then there's exceptions. Yonkers is 1.7%.
Right. That's an addition. That's additional to the mortgage
Yeah.
tax.
No. That's not that's in total.
Oh, that's
So
in
like,
total. That's on your
yeah,
train. Okay, so we're talking about a lot of money, and I've experienced many of these as a bank attorney. You are waiting for documents to be retrieved, and you're waiting for lawyers. It's not quick. Sometimes it could take a few, and it's a little bit tough.
right. So when you refinance, you have to pay that mortgage tax again, unless you do a consolidation, as you pointed out. And that process does vary depending who the lender is that's holding the existing mortgage. Best case scenario, I have seen some banks be pretty streamlined where they can get it done in 2 to 3 weeks. But normally you're looking at anywhere between 4 to 8 weeks. But it doesn't
Right.
stop.
And then you're dealing with rate locks, and people may pay for them, and that's it's kind of complicated. I see a lot of social media posts where just refi, and it's not that case in New York.
Right, not in New York. So the buyer has to make a decision. If they're really rate conscious and they want to lock the rate and close, they might have to just eat that mortgage tax, which could be financed into the loan. Otherwise, they may have to ride the market. And sometimes you can't lock your rate for 3, 4 months. It could take that long, depending on the lender, because once the paperwork comes in that you're talking about, the lawyers have to revise. Sometimes there's revisions required. Sometimes paperwork is lost. They have to do a lost affidavit. So, 8 weeks could turn into like 4 months, you
Sure.
know, it. So the rate is no longer protected at that
I've
point.
seen, even with regard to, I mean, a New York specific thing like co-ops, that the original stock certificates have to be retrieved. So now there's really no control of when the closing date is in New York regarding a cooperative apartment.
Absolutely. I'm doing one now and we're almost clear to close. And we're just trying to find out what's the status of the stock and lease because that gets handled by the seller's attorney. And I've seen them order it early on in the transaction, but sometimes they wait until board approval because
I mean,
they,
and that kind of makes sense. Why are we going to do this until there's approval?
right, why put in all the time and energy until the client is board approved? But what happens is sometimes you can't get the stock and lease for another 6 weeks. So you
Right.
could be that transaction for 2 months, 3 months waiting for board approval, and now you have to wait another 6 weeks for the stock and lease. And as you probably may have experienced already, sometimes that gets lost too. And then it's a whole other thing. You have to do a lost affidavit and then it extends another month. So a 2 month closing could turn into, 6 months in a bad scenario when things go south.
Yeah, they don't realize it's really a three-step process. First, you have to find the place, then they get into the contract, then the board approval, while you're dealing with the mortgage, and then I mean, that's I've seen 6 lawyers that are co-op closing, and it's for everybody. It's
Right.
really
Just try to coordinate that closing with the building's lawyer, the bank attorney, the seller's attorney, the buyer's attorney.
the
It
bank
goes
is.
on. Yeah.
It's when you tell people across the country these things, and they say, "What are you talking?" They've never seen a lawyer, but a co-op has 6 lawyers.
Yes.
They
Yes.
send a
Yeah.
lawyer with the documents,
Yeah.
rip them up or sign them off. Yeah, boy, that's one. New York's a different place for sure.
Agreed. That's why it's so important for us, the Florida relocation team, to educate the buyers because they're coming from a different world. And when they get to Florida, it's a lot easier in Florida in a way, but there's a lot less, protection and monitoring. There's nobody looking over the contract as far as the mortgage contingency. They have to be more aware of what they're signing.
It's on the realtor. I mean, the realtor does many of the deals. They get the closing statement, they do the adjustments. And
Mhm.
listen, it's very common for someone to be selling a unit in New York City and moving to Florida. So it goes from the most difficult process to the easiest process.
Hmm. And I'm beginning to hear that some of the New York folks purchasing in Florida are beginning to look for lawyers now because they want that babysitting.
I know that. I know they want. And obviously you can have your own lawyer to do anything, to go to shopping, just go to the supermarket with you if you want.
Right.
But then, and I've heard someone say, "Who's that person?" "It's my lawyer." "What? Who's that?" And they are now trying to New York the closings, and of
Right.
course, it's more complicated. But listen, that's comes with it.
Well, if you think about it, if they're purchasing a condo in Florida, who is looking over the financials? I mean, as some lenders may have a streamlined condo review where they may not need to look at the financials versus in New York, when you have a lawyer, they're doing that due diligence for the buyer.
Sure.
So it could become scary for a buyer not having any hand holding going from one market to the other.
Yeah, it's interesting. And then even the chain of title, it's complicated. But that's why the Florida relocation team is here to educate, and you have all your bases covered. I mean, you have it all between title and realtor and financing. That's very, very comprehensive, and I know you have a great deal of success.
And we also network with local professionals, both in New York and Florida, as you know. So if somebody's moving, from New York to Florida and they need a divorce lawyer, an accountant, whatever it is, financial planning, we can help with those referrals as well.